Yeah, in this chapter, there is a lot of repeat again, right? How you price the commodities. More or less, we have looked at so many forwards and future contracts with respect to stocks, where the dividends are there, or bonds where coupons are there. More or less, uh, the concepts more or less overlap with those kind of concepts, except for a couple of slides which can really help us out. See, on any commodity, for different maturities, we have different future prices, right? Even in a future or a forward market, let's say for April future, this is the future price. May futures, this is the future price. Or for June futures, this is the future price. Now, for different maturities, we have different future prices associated or forward prices associated. So, whenever I look at the various maturities and I plot a graph with all the future prices, that particular is what I call as a future curve or a forward curve. The same logic which appears to your spot rate curve. For different maturities, you are plotting the spot rates, a graph of the spot rates. We said it's a theoretical spot rate curve. For different maturities, I am plotting the future prices of the security. I am calling it as a forward curve or a future curve. Now, one of the important aspects of this chapter, whenever we are talking of the forward price, right, we generally look at it in terms of the expected spot price on that day. See, when I am looking at today, okay, let me put the position like this. Today is the spot price S0. Here I am expecting that the price of this security, that the price of this commodity will go to some ST. Let's say after 3 months, the price of it will go to ST. Now, generally, whatever is, and again, probably there is some chance that it may go here, there is some chance it may go here, all possibilities can exist. So, whatever I say is, whatever is the expected value of this ST after 3 months, right? And the discount rate could be different for a risk-free security versus the commodity. The commodity price may be growing much more faster. It's a risky security. Commodity is obviously a risky security or very less risky security. Either way it can happen. So whatever is the expected future price or expected spot price at a future date, after 3 months, whatever is the expected price of this commodity, I'll discount it by some discount rate, continuous compounded rate. I'm not using the risk-free rate for discounting. I'm using a different rate for discounting because the rate of return that is expected on holding a commodity could be different from risk-free rate, because it might be a risky security. Let's say I'm holding gold, right? A commodity. Probably it's a risky commodity whose price can go up or go down. So what we are saying is, whatever is the expected price, discount it at some rate of return. That is what we are typically calling as the typical current price of that security, current price of the commodity. It should be the current price of the commodity. The same logic, if I am going with a financial security, I am discounting it by the risk-free rate of return. Now, what is typically emerging out is, if these two rates are different, the rate which I am expecting out of the usage of the commodity versus the risk-free rate of return. See, if both are same, if these two rates are same, what is coming out is my forward rate is same as the expected spot rate. But if the return of expectation on the financial secure risk-free rate of return and the expected return on the commodity, if these two are two different entities, my forward rate and the expected spot rate will have some level of difference existing between them. Right? So the forward rate need not be, what we are trying to drive here is the forward rate for a commodity need not be the same as expected spot rate at a future date. It may be higher or it may be lower based on what is the rate of return that is typically expected out of that commodity. So the arbitrage profit, again, if the forward price is greater than the expected spot price or less than the expected spot price, you can create an arbitrage position. Either you sell in the forward market, buy in the spot market, or you buy in the forward market, sell in the forward market, and or you borrow in one of the markets, you borrow the money, based on that you buy. So it may so happen this kind of a transaction could come out. You see this? If at all there is a difference, you will borrow some money from a bank. Use at some rate of interest. Use that money to buy the commodity. Right? You will hold on to that commodity and you will sell a futures contract. Saying you will sell off that commodity at a future date at some fixed price. If it is higher than whatever the return, let's say after 1 year you are saying I'll sell off this commodity at 110. Today I have purchased it at 100. I'll sell it off at 110. But the loan I have taken is at 8% interest rate from the bank. So what is happening? After 1 year I am sure that I will sell it at 110. But I have to pay only 108 to the bank. Because the interest rate is only 8%. 2% arbitrage profit I am making in the scenario. So wherever the forward rate is different from the expected spot rate, that formula, expected spot rate into E power R minus Q into T, wherever we are seeing that the forward rate is different from that formula, we are taking an arbitrage position in that particular security. Either go long in the forward market, short in the spot market, or short in the forward market, long in the forward market. This is where another concept is getting introduced of lease rate. It's just probably you look at it like, let's say from a seller, I'm selling the commodity. Sometimes what could happen is, I'm selling it by borrowing the commodity from someone else. If I am expecting that the prices will fall drastically, just like a shorting scenario, if I expect that the commodity prices are going to fall drastically, what I can very well do is, I can lease the commodity from someone at some rate of interest. Right? I can borrow gold from you. Look at it like this. I can borrow gold from you, sell it in the market, get back the gold at a cheaper price, and I can refund back your gold. So that is the concept of lease rate. Means someone whosoever is lending the commodity, what is the interest rate he is expecting. So basically it's like that person, let's say I'm holding gold, right? Instead of selling the gold, I'm renting the gold to someone else. So I'm expecting a rental out of it. That's what we are calling as a lease rate. Right? In any case, without me selling and getting rid of gold, I'm selling the gold, which means the ownership is still with me. I'm renting gold. You are in turn selling. But during the process, you are giving me some rate of return. That rate of return, because you have borrowed the gold from me, you are giving a kind of a rate of return on the top of it. That is what we are calling as a lease rate. So from an investor's perspective, we are looking at the return. So whatever they are buying through a lending. So if I have lent to you, you have sold it, your net return is only the difference between the two. Right? You have borrowed gold from me, let's say at 5% interest. That is what we are calling as the lease rate at 5% interest. Now you have shorted the gold. When you have shorted it, you have sold it right now with an intention that the price will fall drastically. You will buy back the gold at a cheaper price and you will refund the gold back to me with a typical service charge, that is in the lease rate which is in the process. So that is what we are. So from a borrower's perspective, if we are looking at it, it is as good as cost of borrowing the commodity. What is the cost you have to pay for selling the gold? You don't own the gold. You are taking the gold from someone else and then you are selling it. You are shorting it. So we have to look at these two rates of return, especially there is a relationship which we always have to look at, the lease rate versus the risk-free rate. In some cases, the lease rate may be lesser than the risk-free rate. In some cases, the lease rate can be more than the risk-free rate. What could be the scenarios? We always talk about the commodity market in two terms: contango versus backwardation. So contango is a kind of a market where the future prices are keeping on increasing. Future prices keep increasing. Now when the future prices are increasing, who would buy to lease the gold, take the gold on lease and sell it to someone? Someone would be interested. See, when you are a short position, you would expect that the market prices will fall. If the market prices, if the futures price is going to rise like this, it means that in the future, the price of this particular commodity is going to increase. Whereas when I talk about the backwardation, the futures price keeps decreasing like this. So I am expecting that the price of the commodity is going to fall in future. So now look at the lease rate. Now there is no one who would be ready to borrow gold and then sell it, because any person who is borrowing and selling it, he is with an intention that the prices will drop drastically, so let me take advantage of that situation. So here what you will find is the leases are much less in number. The leasing will not happen that drastically because the rates are going. The same thing applies to a stock also. The short position in a stock does not probably think of it or compare it with the shorting of the stock itself. Whenever the stock prices are planned to go up in future, no one will do a short position. The shorting typically happens when you expect that the stock prices are going to go down in future. Right? People want to take huge volumes, so they borrow the stocks and even sell them. Same way is happening with respect to lease rate. So what you see is the lease rate will be much lesser in a contango position because the forward prices keep increasing, future prices keep increasing. Whereas this is the major relationship. So in case of backwardation, you see that the lease rate will be much higher. There will be huge demand for selling with borrowing, because the prices of the commodity are expected to go low in future. So people want to borrow heavily and then do a short and do a sell position, so that they want to buy it back at a much cheaper price and refund back the commodity to the original owner. So this is the typical scenario where the lease rate will be much lesser than the risk-free rate in case of Contango and more than the risk-free rate in case of backwardation. This is one scenario where there is a difference between your typical traditional financial forward or future market versus a commodity forward or a future market. And then we also talk about a few more additional things. Storage costs. We have discussed earlier, if the storage costs are discrete, we'll add that storage costs and do the forward the price of the forward contract. If the storage costs are continuous, we'll do that as a part of the power itself. If they are discrete value, storage costs are $200 for the next 3 years, then we'll take it as S naught plus U with this to the spot price itself. You add the storage costs and then do the pricing of the forward contract. But if the storage cost is a percentage terms, 2% of the 2% of the spot price or something like that, then what you will typically do is you will take it as a part of the E power itself, as a part of pricing of your commodity. So that is one. And commodity convenience yield, in some cases holding the security or holding the commodity, if it can give you some benefit. See, the normal thing is perishability and all these things, they are the negative side. In some cases what could happen is holding the commodity may give you some extra benefit compared to selling it off today itself. It could be because of the expectation, probably you can lease it to someone else, right? If you are holding the commodity today, you can lease it to someone else, you can do various other things. So wherever there is a benefit associated by holding the commodity, that benefit is what we are calling as a convenience yield. Again, that convenience yield, if it is discrete, it gets subtracted here. If it is continuous, we put it as a part of to the power itself, generally represented by y, r plus u minus y in the power itself. So if the storage cost as well as convenience yield, both of them are there, we address it through this kind of an equation to price your forward contract. Yeah, this is one thing more and more specific to the US itself. Regarding various commodities, they exhibiting various kinds of patterns in the price. So what they are saying is the gold, you can very well lend it, lease the gold to someone with just holding it. So you can increase your returns by typically leasing the gold. And whereas when it comes to corn, the scenario for them in US is they use it throughout the year, but production is more seasonal. So the price keeps fluctuating. Even here also the production is seasonal, but I think here the demand is also more or less seasonal. I'm not sure whether people use it throughout the year, but yeah, assuming if they are using it throughout the year in the same way, then probably it's like some storage costs are in now. How does the corn price get affected? It is produced only in a particular season, but if it is used across the year, some storage has to happen. So probably let's assume Jan and July are the production months, just for example, or probably only winter is the production month. But if the usage is there even in summer, whatever is produced in winter, it has to be stored. Some perishabilities may come in, some extra costs are coming up. So all those things have to be built up into the April futures contract. But again, when we are coming back to the September futures, again the price is going to come down because that time supply is more than the demand. Because that time the production is happening. Fresh corn is coming up, the old corn may or may not be used, right? And because more supply is coming up, during that month we see that the price will typically come down. It's like a seasonal product, right? Even a mangoes. During the season you see them at a much cheaper price, but they are available across the year now, right? In some of the stores you find them still throughout the year, but the way they are getting is there is a storage cost and all associated with them, and in the non-season you see that the price of those same mangoes will be much higher. So if you are trading in the commodities market, also the same thing. Depending on the nature of that commodity, the prices will alter. And some examples which they have given with respect to natural gas and all, the production is constant, but the demand is seasonal there. Right? Again, if that's the case, probably in the non-season, the prices will come down drastically. So whereas in oil, they are talking about, so the supply also keeps changing. So basically the simple scenario which we have to be comfortable with is, depending on what is the product, if we have to trade something in the commodities market, which is slightly different from a typical financial securities forward market, from the scenario that the production, the demand, and even the storage costs and the convenience yields and all these things, they have different impacts on your commodities. So by understanding all these relationships only, you can think of what should be an appropriate price associated with the commodity forwards or futures. Yeah, one thing which is an interesting numerical that comes out with respect to this commodities is, there are two types of spread that are being discussed in this chapter. One is called as a crush spread, one is called as a crack spread. What they are talking of in this is, let's say this is the relationship. Soya bean as a raw material is used to produce two other products, soya bean meal as well as soya bean oil. Now what we are saying is, these three are traded in the market. If I say the input as well as the two outputs, they are all traded in the market, right? A trader, what he can do is, he can create a long position in this and short positions in these two things, or a short position in this and a long position in these two things and create a profit. That kind of a profit which is getting created by this kind of spread mechanism is what we call as a crush spread. Basically, some raw material is being crushed to create two more other byproducts which are also traded separately in the market. Whereas the same thing, especially when it is applicable to this petroleum products, again the same logic. So the oil, the crude oil, this is also again giving rise to heating oil, kerosene, and let's say gasoline. The same strategy can work here. So I can see, generally as a trader, what I'll do, probably I'll buy some crude oil, use my mechanism to produce these byproducts, right? As a manufacturing company, I'll buy crude oil. I will produce all these things through my manufacturing process, and I will sell off these things, right? So this kind, whatever is the difference I am making by entering into these contracts, so I'll enter into a long position into this, and I may even time it also. Let's say if I am taking 1 month to produce oil, to produce kerosene, gasoline and all these things from oil. So what I'll say, I will get into, let's say, August oil futures, long position, and I will get into September futures for this in the short position. So by fixing the prices in the long market here, in the short position here, whatever the profit I am making, I am calling it as a cracking spread. So basically, these are the names of the processes. Soya bean is being crushed to create soya bean oil and all. The crude oil is being cracked to produce all these outcomes. So the numerical which we can typically look at, probably if you look at this example, it becomes more easier. We are planning to buy crude oil in 1 month. So we want the crude oil after 1 month. So for that, and we use that crude oil to produce gasoline and kerosene. 1 month manufacturing process. So I want to sell that in 2 months from now. So for that, I am entering into a long position on the crude oil. 1 month crude oil long position is $30 per barrel. 2 month future price on gasoline as well as kerosene or heating oil is this much. Now, how do I create a 532 crack spread? Means I am buying 5 units of I am buying 5 units of crude oil. Through that, I am creating 3 units of gasoline and 2 units of heating oil. So basically, I am entering into a futures long futures position for this. So my long position is saying 5 into 30, whereas my short position, this I can sell the gasoline at 41, and I can sell the crude oil or probably the gasoline heating oil at 31.5. So within this period, I have created a profit of 123 plus 63, 186 minus 150. So $36 per 5 barrels is the profit which I have logged by entering into the transaction. So per barrel of crude oil, I have logged in a $7.2 kind of a profit. So basically it is nothing but I am creating a kind of an arbitrage position. Though it's not, I should not call it as arbitrage, it's more of a profit making position. Right? I am fixing up, see, instead of directly fixing up with the direct sellers or direct buyers, in the futures market itself, depending on my process, I'll take 1 month to produce the byproducts. So I am creating a scenario where I am going long in this market at one price, short in this markets at a different price, at a different time. Based on that, I am able to lock in my profits for the entire transaction. Right? Especially when the original product as well as the final product, the manufactured product, both of them are traded on the exchange. We can create a profit position by getting into these kind of various strategies. So in the hedging, especially in the forward, in the futures market, we can look at a strip hedge as well as stack and roll hedge. Stack and roll hedge is a simple mechanism where you are entering into the futures market for the whole amount. And on a periodic basis, you are offsetting some portion of it and again you are re-entering. So probably it's like this. Let's say as per the requirement, you need 5 barrels per month. So which means during a year you require 60 barrels of oil, right? So what you typically do is you enter into the futures market today for all 60 barrels, not for 5 barrels. But this is for 1 month futures only. Which is because you don't have 12 future contracts for 12 months, especially in that scenario. Let's assume that you have only 1 month expiring future contracts, not for 1 year. What you will do in case of stack and roll hedging is, because you require 60 barrels in the next 1 year, You will enter in the futures market for the entire 60 barrels for the 1 month futures itself. Now what you will do, after 1 month, you will offset 55 barrels. You will offset 55 barrels and you again reopen a fresh 1 more month contract for the remaining 55 barrels. Which means 5 barrels you have taken the possession. You have really bought the 5 barrels which you really require in that month. But for the remaining 55, again you are going for 1 more month future contract. So you are taking the whole bulk to start with because you want to make a price advantage of the difference. You have taken a long position, you have taken a short position, you want to take the advantage of the price difference until the last. So for that thing, when I am following this kind of a strategy, where you are taking a future contract with a single maturity for all the future obligations put together and then rolling it over. That is what we call as a stack hedge. But when I am saying strip hedge, probably if there are 12 contracts that are available for 12 different maturities, this is an April futures, May futures, June futures kind of stuff. For each of them, I'll get into 5 barrels long position. This is what is called as a strip hedge. Based on my requirement, I am doing the hedging. But if these many contracts are not available for me, I will typically go with a stack hedge kind of a scenario. But of course, I am exposed to risk across because depending on how the prices are moving, probably my position may change, my margins may change. All these kind of risks are there. Even metal gissel shaft case study, there was a big loss for the company just because of this stack and roll hedging strategy itself. Though it's a good strategy, in some cases, if the price movements are very drastic, it may create a cash flow crisis problem because you may have to deposit margin. There could be a margin call in the middle. And if your position is so bad, especially if you have played on very heavy volumes, the margin which you may have to deposit back could be so high, it may create a short-term cash flow crisis. But otherwise, it's a typical regular better strategy because you can try to benefit out of the change in the prices over the period.